Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate expert Jon Weiskopf. Now, Jon is the CEO and founder of Blue-Eyed Capital, a multifamily investment firm that is on a mission to impact the world one building at a time. Now, with over 18 years of expertise in commercial real estate and a specialization in energy performance and sustainable buildings, Jon's legacy includes leading the charge on over 300 high-performance spaces worldwide as the former head of engineering for Apple Inc.'s retail real estate group. And so with that, it's an honor to welcome Jon Weiskopf to the show. Jon, how you doing today?
Good, Kevin. Thank you so much. I appreciate it. It's good to be
Yeah,
here.
excited to have you here. Excited to just learn a little bit more about you, your company, Blue-Eyed Capital. So how about we back it up a little bit? You know, I gave you a fairly brief introduction there. I'm sure there's a lot more to the story. Tell us a little more about yourself, your background, and then ultimately how you found your way into, I guess, the privatized real estate world.
Sure. Well, first, I'm a father. I have a young son, Wyatt, 4 years old. He is my blue eyes of Blue-Eyed Capital.
Got it.
And a husband, my wife, Danielle, other blue eyes. Mine are brown. So sometimes I deceive people. But let's see. I went to school, 20 something plus years ago to become a race car engineer. And I graduated college and ended up designing HVAC systems in commercial real estate. And, did that for about 20 years. Spent 10 years at Apple, being able to go all over the world and, really honed in skills in sustainability. And about 2 years ago, I was sick of working for somebody else and kind of thought I'd hit success, but realized I just got more work with a small pay raise. That was all I was getting those days. And decided to jump into multifamily and really, I think my objective is, what was I going to leave my son? I could leave him money, but really was that ultimately what he needed? And, I saw this hole in multifamily operations of, people need help. We need more healthy homes. And how can my expertise be applied to creating a better world and a place where my son, 30, 40 years from now can thrive?
Yeah, no, fantastic. I appreciate that. Incredibly helpful. And kudos to you for making the switch and stepping out on your own. So I'd love to talk about, what that transition point looked like, leaving the corporate world and switching over to the privatized real estate sector. And I'm assuming, are you full-time in the real estate thing today?
Yeah.
Or, okay, got it.
Yep.
What did
Left
that look
Apple,
like?
quit cold turkey.
Yeah, really? Okay.
Well, if I knew what I was getting myself into, maybe I would have been a little bit different. But I started my company while I was actually on a leave of absence from Apple. I took 3 months off to kind of clear my head, and I was stressed out, overworked, and I just needed clarity. So during that time, I was like, I'm not doing enough. And so I started Blue-Eyed Capital, and I was working on the side. And 6 months in, I was like, I can't do this. If I'm going to do what I want to do, I have to go full in. So I quit Apple. My wife and I relocated to be closer to family, and ever since I've been 100% Blue Eyed Capital. And since then, we've got 3 properties under our belt so far.
Okay.
So
Talk
it's
to me about
been, yeah, sorry, go ahead.
Yeah, no, that's fantastic. Appreciate that. I was going to say, tell me about the properties. I guess obviously you chose multifamily. That was the asset of choice. For a multitude of reasons. I mean, multifamily's just been it's been a winner for many years now. And the continued need for quality affordable housing is still very present today, if not more than it was years back. I mean, it's just continued to grow, and so multifamily is a great fit for that. So talk to me a little bit about a little bit more the business model. Exactly what type of multifamily assets are you guys seeking? Size wise, geographical focus. What's the business model look like?
Sure. So we are specifically focused on impact investing. And, my first property maybe wasn't under that guise as I had just started out, but we are looking for assets in the affordable housing sector. Some with credit, some without, some with vouchers, some without. So really C class. Want properties bigger than 50 units, ideally greater than 100 units. I think this become a little bit easier to manage. And our current market focus today is in the southern Midwest area, Kansas City and Oklahoma City and Tulsa.
Okay. What's happening specifically in those regions that's attracting you guys to the area?
Tulsa, if I look at Tulsa, Tulsa has a affordable housing and housing authority wait list of over 5,000 people. And they have a government that is committed to helping fix their affordable housing problem. So from a government, from a policy perspective, and from a demand perspective, it's prime, and it's great town. I think it's got a lot going for it. It's growing, population is moving there, but it's untapped. When I started this, I was adamant about staying away from Florida and Texas. Though I do have one property in Lubbock, Texas. Again, another growing city, right? Maybe not at the scale of Dallas, Fort Worth, and some of these other big major metros, but they have a big workforce housing sector, right? In demand, same as Kansas. You look at Kansas City, Missouri is booming in population. My property is in Leavenworth, so secondary, maybe even considered a tertiary market, but we're looking at picking up on the influence that these large booming markets that Kansas City, Missouri is having in growth. It's pushing those needing individuals in that C-class properties out to those outer markets, right? They no longer can afford downtown. Now they push the secondary, tertiary markets. And so those are the types of properties we're looking for.
Yep. So speaking to, let's go back to Tulsa. So interestingly enough, we had a property under contract in Tulsa a few years back. Actually, a parking investment. We own mobile home parks and parking lots, and I'd actually never been to Tulsa. Obviously, the data would suggest that it's a growing market, heading in the right direction. But I'd never visited, and I made a personal visit there, and I was shocked in a positive way, more specific to the downtown area of the growth that was happening in downtown, just the vibrancy of that area. Lots of young folks, lots of new, really high end A-class apartment complexes and high rises going up in downtown. Lots of trendy restaurants, and so I did not expect that upon arrival in Tulsa. And so I was again positively shocked, and again just it seems like it's got all the ingredients of a great growth market. And so, speaking to the point you made of there's roughly 5,000 on the Section 8 voucher program on a wait list in the Tulsa region. Um, when you're looking for an opportunity, again using Tulsa as the example, are you looking to really either acquire an apartment complex that is predominantly Section 8, or if it's not, converting a portion of it or all of it to Section 8 vouchers?
Sure. We don't necessarily convert anything. And I think affordability doesn't necessarily have to have vouchers with it. So,
Hmm.
I have a low income housing tax credit property in Louisville, Kentucky. We look for them. We don't shy away from those. But affordability is more about the rent that we are charging versus the area mean income that's in that location,
Hmm.
right? Anytime rent is over 30% of area mean income, it means that those individuals making that income are going to be stretched. They're going to be disadvantaged from a affordability perspective, right? And so then those individuals need some sort of assistance. So we use things like Catholic Charities helps fund some of our rental payments for some of our residents and some of our other properties. So I think there's multiple opportunities, Kevin, to kind of fall into that
Yeah.
affordability group.
What are some of the challenges with owning and operating C class complexes? Again, you're in a number of different markets, so you can probably speak to maybe some uniqueness market to market, but there's also I think some generalities as it relates to just challenges that come with maybe operating a C class workforce housing type community to that of maybe a B plus class or an A class apartment community.
Sure.
Any challenges that come to
Um,
mind?
oh yeah, plenty. The first one I would probably say is just the building itself, the asset itself.
Hmm.
I think those assets have, in general, been less well maintained than a Class A versus
Hmm.
Class B, just in general. So you're typically buying something that's going to need care. You have to be willing to put the time and the effort and the money into correcting some of those problems and know where to find those problems. Um, Being an engineer for 20 years, that's where my acquisition specialty kind of steps in. The second is the individuals themselves. A lot of folks that are in that sector, they're living paycheck to paycheck. One disruption in life can cause them to miss rent. Not all of them have stable jobs. They don't have annual salaries like somebody making working for Apple or working for another tech company or things like that, right? So I think, and then the third thing I will say is trust. I think individuals in that demographic, they've been taken advantage of in the past. They maybe have a different trust issue with landlords and other things like that. And so, as an owner, you really have to make sure that your property managers are spending time rebuilding trust, letting them know that they have an owner that is there for them and they're trying to make a difference. And I think a lot of them don't have that or have come from histories of not always having that. That's not meant to knock. There's wonderful landlords out there, but different things that those individuals are looking for from
How
an
do you
ownership.
effectuate that alignment with? I'm assuming if you guys use a third party. I shouldn't assume, but are you using a
We
third
do.
party property management company? Okay, yeah. How do you effectuate that trust, or just really that, um, I guess kind of your mission as a company? How do you help filtrate that through that property management company through that resident base? I mean, I've used the reason why I asked that question. I know there's some great third party property management companies out there. There's some really horrific ones, and there's a bunch of mediocre ones right there in the middle, just like everything else. Um, and I've always there's always been a challenge. We manage our own stuff today, but for many years, I mean, we outsourced a good chunk of not all of our portfolio in different asset classes to different third party management companies, and always just found a challenge. I mean, some were way better than others, but always just felt a challenge of being able to pass our core values and kind of our company mission and just really get the property management company on board with actually rolling that out throughout the community and helping kind of pass on what was important to us and what we felt was important to the residents at each community that we owned. Just wondering how you guys, if there's anything unique that you do to help again effectuate that.
We have written policies about what is important to us and what we're going after and how we like to address people. We use the word residents, not tenants, right? We try to
Mhm.
make people try to just do. I think it's a little bit of just changing perceptions about things, changing ways of doing things. I will say that my goal is to ultimately have my own property management because I think what we have learned is nobody is ever going to act in your interest fully if they're a third party. They ultimately have different objectives as their own business that is running and operating. But every Tuesday I have two property management meetings. I had one this morning with my section 8 and low income housing tax credit property, and that's probably by far one of our hardest ones to manage. And we are constantly looking for our property managers to tell us, why did somebody miss a payment? Have you spoken to them recently? And so a lot of it is just about having one-on-one engagement with residents. That property is a 64 unit, so it's a little bit easier to manage than say a 200, 300 unit one might be. But it's constantly looking at, have we talked to them? Are we doing this? Are we doing that? Asking questions, holding them accountable, and constantly trying to stand the way that we want to stand.
Mhm. Have you noticed any major Any major shifts, just as far as collections or just quality of tenant base, or even achieving maybe market rents that you guys set forth in a pro forma in the last couple of years of acquiring these properties? Like, have you noticed any major shifts in the last couple of years? Just again, unemployment rates creeping up a little bit. I mean, it's inflation's just it had been out of control. I mean, things are just incredibly expensive, even even more impactful, right, to the demographic that both you and I serve. I mean, I think we serve a very similar demographic, us being in the manufactured housing space, but a very similar quality of demographic, and probably similar incomes, similar house makeups, and things of that nature. So just curious as to what you're seeing in your space as it relates to that.
It is a struggle.
Mm-hmm.
I think the hardest thing that I have had to learn in this process from starting my company was um, evicting somebody.
Mm-hmm.
It's one of the hardest things to do. But we've had to go through and change the demographic by evicting individuals that were never going to pay and were taking advantage of the system. And I think it's a hard balance, or it's a hard thing to balance, because some people just haven't paid because they missed the payment. They missed shifts that week before. And that's where that personal, we try to do payment plans for every single person. We give every single person a chance to go on a payment plan if they miss. But we've been able to recollect a lot of our past due stuff, Kevin. We've had to look at where we're getting individuals from residents. So we do work with a lot of charities and nonprofit organizations that help assist in paying individuals. We work with a lot of relocation services and immigration services and individuals coming from actually out of the country, and work with folks. So, but every week, I think every month we have an eviction. We have people that just can't pay, and it's a hard balance. But we have started to see things start to creep up a little bit in the past probably 2 months, I think.
As far as what delinquency is creeping up?
Delinquencies, yeah.
Yeah. Yeah. Okay.
Yeah. We got to our point where we were quite well in our economic occupancy. We were 90% plus the last 3 months of last year and into the first couple months of this year. And we've slowly started to see some delinquencies starting to creep back up. And I don't know if that's just summertime and time of year at the moment. It wasn't the same last year. But
yeah, no, fair enough. Curious to how are you guys, are you doing anything unique to navigate the debt markets? Again, I'm not sure exactly what type of debt you've got on these properties, or what type of debt you normally put on new acquisitions. I know you are going through a few current acquisitions now, but just generally speaking, how are you navigating some of the volatility that we've seen now over the past year and a half?
sure. Luckily, or intelligently, smartly, I'm not sure, but I'm definitely going to use luck in there. All of the debt that we have is fixed debt. We have the 2 properties that I picked up about a year and a half ago. Those were on assumable debt. And I do have a mobile home park that we're under contract with, trying to close on. That's assumable debt. That's assumable fixed debt. I do have one bridge loan, one fixed rate bridge loan. And that one, that's for a property we picked up earlier this year. It was a 72 unit in Leavenworth, Kansas. But that one we had to work into our pro forma. But we weren't willing to take variable rate yet. We still weren't sure where things were going, and so we settled. I think I forget what that rate is exactly. I think we're at 8.6 or something like that, in that range.
Yeah. Okay. And then, just curious on that particular one, like, what is that business plan? Is it a 2 or 3 year business plan, and then, recapitalize that asset, or what's the long-term vision?
That one was a very well found off market deal. We bought it for 4 million, and it was appraised value is 5.9. So the fixed debt is we're already in the process of starting to refi.
Okay.
So that business plan, we has a lot of people month to month. It was a family owned property for a better part of 20 plus years. They had 90% of their leases were month to month.
And what's
well below, and
is
below
there an
market.
improvement plan there in order to get people to annual lease and maybe get higher market rates? I mean, is there a renovation plan that's
Yeah.
set forth, or?
Yep, the property was actually maintained fairly decently, to be honest. But we've been going through and doing upgrades as tenants. As we've moved people into fixed term contracts and leases, they've said no to new rates. They leave. We go through and we do minor upgrades.
Mm-hmm.
Yeah, but it's
Yeah.
been minor, and that one's been great. We're actually 6 months ahead of cash flow on that one.
Oh, fantastic. Yeah.
Yeah,
Congrats.
yeah. A lot of
So
people took the lease increases without moving out.
yeah, yeah. So curious as to like what has you excited for the next next 12, 24 months. I mean, just kind of what does that future vision look like for the growth of the company, and what keeps you up at night in a positive way?
I impact is my focus. I think I said it, and I think that just sometimes it's hard to say that the opportunity to impact is growing because it means that there's problems out there to solve. And
Hmm.
sometimes that affordability problem, sustainability problem, climate change, those are all things that I believe are coming, and they're in fact already here for a lot of time for a lot of individuals. You see it in insurance, you see it in utility rates and things like that. So what keeps me up is I know what I'm doing is going to have an impact. I know that there are people that need healthy homes. I know that there are people that need sustainable homes for foreseeable future.
Hmm.
So we're excited just to be coming into a niche in the market. We don't think a lot of people are pushing impact, and we think there's substantial opportunity to not just be financially ahead of the game, but also use that money towards good in the world and create a better future.
And what does that mean? Just maybe elaborate a little bit more on what impact means to you and your organization.
Sure, we have this mantra in Blue Eyed Capital: a healthy home, healthy person, healthy planet.
Hmm.
And so by giving somebody a home to thrive in, by making it sustainable, upgrading it, sustainable, energy efficient appliances, energy efficient air conditioning, proper lighting, things like that, good landscape and all of that things, right? A home to be proud of for that individual. That person goes out into the world and starts to thrive better. They produce more. Maybe they get a better job. How does that person live within our apartments? They're there for long term. We want our tenants to be there, residents, excuse me, to be there forever, right?
Hmm.
That's our ideal. Our ideal resident is somebody that is there for the long haul. And by being sustainable and creating these healthy homes, we believe that we are able to impact communities. And that's just what our job is to do. It's not just money, right? We need paying tenants, and the world is changing drastically and quickly, and
Hmm.
everybody's going to be affected by utilities and all that stuff.
What have you found to be the best resource for finding new opportunities that fit your buy box?
Brokers. I think we've just recently, I think I said I have a mobile home park under contract. We've just recently started to realize that even the apartment field is becoming harder and harder to play in from an affordability perspective. And so we're constantly looking at the balance between apartments that need our love and need our tender care. So I think there's a lot of individuals that don't want to do their value add is more lipstick based. My value add business plans are more heavy upgrade based.
Hmm.
And so I think that provides an opening where not a lot of individuals want to play it.
Yeah, no,
So
I
that
definitely
buy
agree.
box being clear and being specific to that buy box, I think there's less deals for us to get, but when we see them, there's less people going after them.
Hmm. And you mentioned like number of your deals are like 50 units to what, like 100 units, or what, like what's the ideal size? I mean, obviously a lot more efficiencies come with larger opportunities, but then also a lot more competition comes with those as well. But what's kind of the ideal size or that niche that you're trying to play within?
My ideal size would be anywhere from 70 to 200 units, I think, and maybe even to be more specific, 100 to 200 units in that range. That's where I think we have the ability to be the most impactful. To date, I just haven't been able to pick up any in that size yet.
Yeah, what are you seeing now? I mean, like literally in the last couple of months, I mean, are you seeing more? Well, I know the transactional volume is down across the board in every asset class, but just have you seen any what you would classify as opportunities, maybe distressed opportunities, or maybe more so, may not distressed properties, but distressed partnerships or situations that are forcing folks to exit out of properties at a not so ideal time?
Not at the rate at which unfortunately for other people, I was hoping to see. I wanted to see more distress. There's a big private lending market out there right now that I think is propping people up. There's a lot of money out there that's willing to do preferred debt, or preferred equity to help somebody do loan extensions and things like that. So we personally have not seen the ramp up in distress deals. Thanks for clarifying how you mean distress, right? We have not seen the volume increasing at which we expected it to see, and I guess we're really hoping. But we are seeing deal flow, or at least available deals out there, starting to increase.
Yeah. And how have you adjusted to underwriting? I mean, when you're modeling a deal today, I mean, what type of annual increases do you put in place? And then, what type of again, none of us have a crystal ball at all, but we still have to, if you're running a 5 or 10 year model, you got to put some type of exit cap rate in there. If you intend to recap a deal at some point along the way, you got to put, what do you think the debt's going to look like at year 3, 4, or 5, whatever that recap is going to come into play. Just curious as to what type of metrics you're using there.
Sure. Biggest shift I would say is looking at 10-year holds versus anything in the 5-year range or less.
Okay.
So the longer holds means we really disregard IRR for the most part when we're looking, just because we're in that 10-year time frame. Cap rates, only fixed rate debt. We will only do fixed rate debt. That's just us. That's all we want to do. We want to know what we're getting into. And we'll typically deal with the standard prepayment penalties and things like that. But we want to be able to refinance. So we're looking at deals where value add over the first 5 years allows us to refinance, cash out, and get investor money back for that 10-year hold. Exit caps. I'm a pessimist when it comes to exit caps. I also think cap rates are so loaded, but I'm a pessimist, and I usually keep my exit cap above a 7. Above a 7.
Yeah.
But we're trying to be positively leveraged, even if I'm positively leveraged a quarter point, right, where I'm purchasing before versus where I'm getting debt, right? And today debt's coming in the mid sixes to low 7s is where we're finding debt hit us. So
are you mostly using regional banks, or I know you've done a lot of assumptions. Are they agency loans that you've assumed, or what type of debt have you stepped into recently?
One is agency, the rest are regional. And we look for agency where we can. So our latest property in Leavenworth, that was a small lender for bridge debt, and that will be refinanced into agency debt.
Got it. All right. Well, fantastic. Well, Jon, for those that want to learn, I guess, more about you and the company and just get more information, maybe follow along and just see opportunities when they come available from your group, where's the best place to track you down and learn more?
Sure. Information about us and current opportunities is website, which is www.blueeyedcapital.com. And for information more about me and kind of to stay in tune with in real time is LinkedIn. That's where we do all of our effort posting and marketing efforts.
Okay, fantastic. Well, Jon, appreciate you coming to the show today. It's been a pleasure meeting you and speaking with you. And thank you for sharing all your insights and all that's going great with Blue Eyed Capital. And wishing you all the best, my friend.
Thank you. Appreciate it. Great to be here.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.